Hi everyone, I hope you're having a great day. As we approach the end of 2024, now is the time to take control of your finances and make some strategic moves that could save you money, reduce your tax burden, and set you up for a stronger financial future. Whether you're planning for retirement, education, or looking to give back to your community, there are actionable steps you can take right now that will make a meaningful impact. So let's talk about what you can do with your money before the clock strikes 2025. So let's start with something many people overlook: maximizing your retirement contributions. Your retirement accounts are more than just a safety net for your future. They're also a powerful tool to reduce your taxes today. For 2024, you can contribute up to $23,000 to your 401k. And if you're 50 or older, you get an additional $7,500 to play with. That's $30,500 in potential contributions that reduce your taxable income dollar for dollar. And if you got a raise this year or started a new job mid-year, you might have room to increase those contributions before the December 31st deadline. Every little bit counts, so check your year-to-date totals and see if you can push a bit more into your account. Though if you don't have access to a workplace plan, don't worry. Individual retirement accounts, or IRAs, are an excellent alternative. You have until April 15th, 2025 to make contributions for the 2024 tax year. But why wait? If you can contribute now, your money starts working for you sooner. Plus, you can contribute to both a 401k and an IRA in the same year, which is a great way to turbocharge your retirement savings. Just remember to keep an eye on those income limits if you want to deduct your IRA contributions. And speaking of saving money, let's talk about tax loss harvesting. This strategy is perfect for anyone with investments that didn't perform well this year. By selling investments that are currently at a loss, you can offset capital gains from other parts of your portfolio. And if your losses exceed your gains, you can use up to $3,000 of those losses to lower your ordinary income. Any leftover losses? You can carry those forward to future tax years. This is one of those win-win strategies where you're reducing your tax burden while repositioning your portfolio for future growth. Just be careful about the wash sale rule. It prevents you from buying back the same investment within 30 days. So, plan your trades wisely. On the topic of planning, let's shift to charitable giving. The holiday season is the perfect time to give back, and doing so strategically can also benefit your finances. If you itemize your deductions, donating to a qualified charity can reduce your taxable income. This includes cash, appreciated assets like stocks or real estate, and even non-cash items like clothing or furniture. Donating appreciated assets, in particular, is a powerful move because you get to deduct their full market value while avoiding capital gains taxes on the appreciation. If you're someone who typically takes the standard deduction, consider bunching your donations. This means grouping multiple years' worth of donations into a single year to exceed the standard deduction threshold. Now let's talk about education savings. If you or someone in your family is saving for education, 529 plans are an incredible resource. Contributions grow tax-free, and withdrawals are also tax-free when used for qualified educational expenses. Some states even offer additional tax benefits for contributions. Thanks to recent changes in the law, 529 plans are now more flexible than ever. For example, unused funds can be rolled over into a Roth IRA for the beneficiary, up to a lifetime limit of $35,000. That means your money doesn't have to go to waste if plans change. It can still contribute to the future financial health of your loved ones. Another area to consider before year-end is healthcare savings. Health savings accounts, or HSAs, are often overlooked, but they offer a triple tax benefit. Contributions reduce your taxable income, growth is tax-free, and withdrawals are tax-free when used for qualified medical expenses. For the year 2024, the contribution limits are $4,150 for self-only coverage and $8,300 for family coverage, with an extra $1,000 allowed if you're 55 or older. Unlike flexible spending accounts, HSAs don't have a use it or lose it rule, so your unused funds can grow year after year, making this a smart long-term savings tool. For those who are self-employed or have freelance income, here's a tip. Consider delaying some of your income until January if you expect to be in a lower tax bracket next year. On the other hand, if you expect your tax rate to increase, you might want to pull some of that income into this year. Timing your income and expenses strategically can make a noticeable difference in your overall tax burden. And if you have any large business expenses, think about making those purchases now to take advantage of deductions in the current tax year. Now, let's address those of you who are 73 or older. Don't forget about required minimum distributions, or RMDs, from your retirement accounts. Missing an RMD can result in penalties, but there's a way to turn this requirement into an opportunity. It's called a qualified charitable distribution, or QCD. By donating up to $105,000 directly from your IRA to a qualified charity, you can fulfill your RMD obligation while excluding the amount from your taxable income. It's a great way to give back while reducing your tax bill. Also, let's not forget estate planning either. If you're in a position to make gifts, now is the time. For the year 2024, you can gift up to $18,000 per recipient without it counting against your lifetime gift tax exemption, which is currently $13.61 million. These gifts can help you reduce the size of your taxable estate while providing meaningful support to your loved ones. And don't underestimate the value of directly paying for someone's education or medical expenses. Those payments are excluded from gift tax limits entirely. As we wrap things up, let's look ahead to 2025. Some key provisions of the Tax Cuts and Jobs Act are set to expire, which could mean higher taxes for many people. This makes now the perfect time to consider strategies like Roth conversions. By converting some of your traditional retirement accounts to Roth accounts this year, you'll pay taxes at your current rate, but enjoy tax-free withdrawals in the future. If you expect to be in a higher tax bracket down the road, this can be a very smart move. So, there you have it, practical, actionable steps to make the most of your money before 2025. Whether you're maximizing your retirement savings, reducing your tax burden, or giving back to your community, these strategies can help you finish the year strong. I'd love to hear from you. Which of these tips are you planning to try? Let me know in the comments, and if you have any questions about your own situation, feel free to ask. Remember, while this provides valuable information, it's a good idea to consult with a qualified financial advisor or tax professional to tailor advice to your specific circumstances. Thanks for joining me today, and here's to a successful and financially rewarding end to the year.